Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Tonight, Robin Hood goes public. The Biden administration says government workers must be vaccinated or mask up. And the Black Widow has a new enemy named Walt Disney. Scarlett Johansson is suing Disney because even though she received a $20 million upfront fee for doing Black Widow movie, by streaming partially rather than just the box office, she says it's cost her millions in ticket sales. And you thought you had problems. That and more tonight, all on Wall Street Wrap-Up. Hi, and welcome to Wall Street Wrap-Up. I hope your week went well. I'm Andre Laborde. Our goal is bringing Wall Street to your street. For today, Friday, July 30th, 2021, and to get you ready for the week ahead. Now, tonight, we're going to be talking with Sebastian Page. He's in charge of the $450 billion T. Rowe Price Global Multi-Asset Division. We'll be discussing the best places that he thinks the remainder of 2021 will be good for investing and into the next year as well. He's also written a book called Beyond Diversification, What Every Investor Needs to Know. And we will be asking him just what does every investor need to know? And he'll be with us tonight. But first, how did the markets do this week? Well, the Dow Jones Industrial Average ended the week at 34,935. That was down 149 points for the day and down 0.3 of a point for the week. And the S&P 500 closed today at 4,395, down 23 points for the day and down, again, 0.3 of a point for the week. And finally, the NASDAQ. They finished the week at 14,672, down 105 points for the day and down 0.1 of a point for the week. The analysts at Jefferies raised Microsoft to a strong buy with a new price target at $335 a share. And Credit Suisse raised Amazon.com to a new price at $4,850 a share. And Citibank raised Apple to a strong buy with a new price target at $175 a share. Well, my guest tonight, this evening, runs the T. Rowe Price Global Multi-Asset Division with over $450 billion in assets under management. He's also written a book about diversification and investing, which we'll also be getting into. His name, Sebastian Page, and he's with us tonight. Hi, Sebastian. Welcome to Wall Street Wrap-Up.
Thank you. Thank you for the invitation. I'm happy to be here today.
My pleasure. Sebastian, let's get right into it. Question about with the COVID virus, that a lot of people are coming down off of lockdowns, but now there seems to be a new variant, the Delta variant. How do you think this will affect the markets coming for the remainder of 2021?
Look, I don't want to minimize the risk of the Delta variant, especially in countries where vaccination rates are low. Mm-hmm. And the other caveat is I'm not a doctor, nor do I play one on TV. But I do think that the media in general these days has a bit of a negativity bias, and there's a fair amount of overreaction. I do not want to get political, but right now, if you just look at data statistically, one of our analysts has estimated that, look, based on the data we have right now, the flu is more dangerous than COVID in the US in terms of the number of severe disease and deaths. We're bullish on the economy. And one of the numbers I keep going back to is $2 trillion in excess savings. That is 25 years of excess savings accumulated over the last 12 months. I think a lot of it is yet to be unleashed in the economy. And you have infrastructure spending coming. The problem is that everyone else is bullish on the economy. In our division, overweighted stocks around the COVID bottom last year. We bought 12 billion worth of stocks across our portfolios. We didn't time the bottom perfectly, but we like to lean against the wind, and we did. We've stayed long for the ride. Mm-hmm. We've stayed long for the ride, and we've benefited from the recovery in stocks. But I was just going to say, a few weeks ago, we started underweighting stocks.
You brought up something that was very interesting because I was going to ask about it too. Because with all the stimulus money and money that people have been saving due to whether it be federal stimulus or for whatever the reason, I understand that there's something like $3 trillion in the market right now globally, and of that 3 trillion, as you just mentioned, like 2 trillion. Two-thirds of that is right here in the United States. Where do you think that money is going to go to when it comes to asset allocation?
Well, you can look at some of the data and you'll find that a lot of it is actually making its way into the markets. And there's some data that shows that about half of stimulus checks are actually being invested in markets. There's data that shows that we've had 10 million new brokerage accounts opened this year, and that's equivalent to 10 million in 2020. So just year to date, 10 million. So you're even seeing an accumulation in new brokerage accounts being opened. But you also have in the survey data information that shows that people are spending a lot of it on necessities, like food and rent and monthly bills. There's also some data that shows that 13% of the respondents are saying, look, we're planning on spending it on discretionary items. So the bottom line is that there is some of it that's being invested, some of it on the sidelines, ready to be unleashed. You can expect more spending on services as we continue to reopen. And all of this really speaks to this idea of pent-up demand and recovery and reopening. That trade has not done so well over the last 2 months, and maybe there are worries about the Delta variant and other factors, such as the Fed being too aggressive. But the bottom line is that the conditions are there for more money to be unleashed into the economy. Look, the consumer, you can expect a strong consumer with all these positive data on spending habits and spending plans. We just sent 130 million checks of $1,400. That's kind of dropping money from the helicopter, and a lot of it still hasn't been spent. So I think we've seen a pullback in the recovery trade, but if you take a 6 to 18 month horizon, which we do in our process, you can still be long the economy, long the recovery trade.
I understand. And I agree with you that just even a portion of that $2 trillion, of a percentage, a small percentage of that, that's a lot of money going into the equities market or into other types of asset allocation, such as that. Sebastian, what do you think about with the travel industry right now that's just starting to be getting ramped up? Just all the airlines are now releasing their quarterly results from the second quarter. Hotels are as well, too. And it seems like people are just pent up, can't wait to get back either on planes, go out of town, go for doing that. Do you think that third quarter is going to be back to normal? Or maybe will it take back to fourth quarter before things are going to be going back to normal for hotels, airlines, and such?
Quarter to quarter, it's a little bit unpredictable, but the trend is our friend here in terms of reopening, which means there are opportunities with the recent pullback in the reopening trade. I work in top-down in asset allocation, but I also look at our analysts' recommendations. And at T. Rowe Price, we have 500 analysts and portfolio managers, one of the world's largest platforms for fundamental research. And our analysts are upgrading companies in the value sector, including in the transportation sector. If you look at TSA data, we love to hate the TSA process going through the airport.
Right.
Well, they've started compiling their data and making it available. So our analysts are really on top of those types of alternative data sources because they get updated very frequently. And right now we're looking at 82% of the pre-pandemic level in terms of people going through airports. So you could say from that perspective, we're 82% reopened. If you look at Clear data, I don't know if you've used Clear, but that's a process where you can really bypass the line, but you have to pay up for it. You go through the same security process, but it's associated with business travel because there's a cost to it, and business people, when they travel, they like to use Clear. That one is at 66% reopen relative to pre-pandemic level.
Do you think businesses that normally before the lockdowns that used to have their people go visit other areas, the travel, will be eventually getting back to where it was pre-March of 2020? Or do you think that now that people have gotten more into a groove since March of 2020 when they've been doing Zoom or other types of comparable types of internet, will that business travel be as strong as it was prior?
I don't think that business travel will be as strong, and especially for international travel. Speaking for myself, I've traveled on business for years, and especially early in my career, I would get phone calls and we need you in Japan, and it would make me feel important. And I would fly to Japan for a big finals presentation. I think a lot of that inefficient kind of frenetic travel is going to be pared down. I don't know by how much, 10, 15% maybe. And also talking with our salespeople, there is a difference between client service, where you have a really good relationship with your consumer. And I'm not just talking about our industry, I'm just talking philosophically in general. Client service, when you have a good relationship, you can probably do a lot of this remotely and via Zoom, for example. But sales, I think the in-person relationship building aspect of sales is not going away. So I'm kind of in the middle of the road with respect to forecasting in terms of the level of business travel in particular. To your question, maybe we end up 10, 15% lower. I think there's a lot of pent-up individual travel, personal vacation. I'm in that camp. I'm really eager to go and spend time in some nice places that I haven't had a chance to go to. And I don't know if you feel the same, but I think a lot of people.
I know a lot of people who are tired of just watching the inside of their home or their apartment. Right. They can't wait to go ahead and do it. Sebastian, what about this too with inflation? We've had different camps. We've had economists on the show, and some have said it's transitory, temporary, and some economists have said, no, this is going to be here to stay. What camp are you in? Do you think this is like a bottleneck that will eventually be evening itself out for inflation, or do you think that we're looking at some long-term inflation?
That's such a good question for an asset allocator these days. If you're an asset allocator, you're probably losing sleep over the inflation call this year. It is the question. I'm in the transitory camp with a caveat. I do think we can settle back at a slightly higher rate of inflation. We just had a quarter over quarter from 1 year ago, so call it year over year, CPI print of 5.4%. That is a really high number, and I think it's scaring some commentators and even economists, because economists are trained to worry about inflation, right? With textbooks and models and data that go back to the 70s. And I'm not an economist, but I'm an investor. And my view is that most of this print is temporary. It's in the data, right? Used cars and trucks up 45%, gasoline up 44%, airline tickets, the last data I looked at was in May, to your earlier question, up 25%. So those are all reopening effects that are built in that last 5.4% print. But shelter up 2.6%. Now that includes hotels, but that's higher than trend. Or even food up 2.4%. So I think that's more indicative of the new normal. You have to look at wages too, because wages tend to go up, but it's very, very hard for wages, if ever, to go back down once they go up. So it's very sticky. So I think that's more illustrative of the new normal for inflation. But even in that 2.6% for shelter, you have hotels and you have a bit of a reopening effect. However, you have to watch rents, because house prices are way up, but rents haven't kept up, and they tend to lag house prices.
Do you think that right now the Federal Reserve and Jerome Powell, the chairman of the Federal Reserve, is saying that they're going to be wanting to keep interest rates low until they've said everything throughout 2022 and possibly at the beginning of 2023? Do you think that they're going to continue to do that And do you think maybe the canary in the coal mine will also be the, let's say, the $120 billion a month bond purchases? That in addition to keeping interest rates low, they're buying about $80 billion a month in treasuries and about $40 billion a month in mortgage bonds. Do you think that they're going to continue that as well too throughout the remainder of the year and throughout next year? What are your thoughts?
It's interesting you bring up the canary in the coal mine. We often use this analogy without thinking about it too much. I think the analogy is you sent the canary, and if the canary dies because of methane or just,
right.
Gas in the mine, then you know that there's something bad. So it's an interesting analogy that you chose there. I do think that, and it could be that pulling on QE too fast, which I do believe would happen before raising rates, would be the canary in the coal mine. That it would be, it would be an event that is symptomatic of a real problem. But I'm not too pessimistic on Fed action here. Look, it's clear that rates are remarkably low. 10-year yield, as we speak this week, around 1.2%. We just talked about inflation. Let's say we take 2.2% to take a round number based on our prior discussion, right? If I take inflation out of the 10-year, I get some estimate of a real yield, what I get after inflation on a 10-year bond. That's minus 1%. Minus 1%, close to an all-time low. People talk about risk-free returns in treasuries. I think you're now talking about return-free risk, because the rates can mostly go up from here. There's clearly an asymmetry. So the market is watching this, and that's driven by the Fed, growth expectations, inflation expectations, speculation, short covering, foreign investors buying. Hedged 10-year yields for Japanese-based investors are actually fairly high right now, highest since 2016. So my base case is the Fed will remain quite dovish. The Fed doesn't want to surprise markets. And one more thing I'll say about this, and it's bothered me about markets for a while, and it's more of a philosophical point, but we've kind of reached a regime where the Fed does watch financial conditions, right? Of course, full employment and controlled inflation is the dual mandate, but the Fed is watching the markets. And what are the markets obsessed with? What are we talking about today? The Fed. And it creates this circular reference. I don't know if some of you viewers use spreadsheets, but if you ever use a spreadsheet, you know that a circular reference doesn't work very well.
We're going to take a break. We're talking with Sebastian Page, and Sebastian is the head of the T. Rowe Price's Global Multi-Asset Management, over $400 billion in assets under management. We'll take a break, and we'll be right back, so don't go away. And we're back. We're talking with Sebastian Page. Sebastian, thank you. We were just talking about inflation and the inflation trades. How will you have to rebalance your portfolios of your funds that you oversee, depending on inflation, of whether, like right before we left for a break, we were talking about whether or not they're going to be raising interest rates or not. Have you balanced your portfolios in a way that if they do raise rates, you won't have to rebalance, or you will have to rebalance?
So we're short duration. So strategically, we have an allocation to long bonds to give some protection to our investors relative to stock market risk. And there aren't that many areas of financial markets where you can get some protection, and long bonds is one of those. And our process is a two-stage process. We have a strategic process where we determine the long-term asset mix for the investor. And then we have a tactical process where we look at relative market valuations and adjust accordingly leaning against the wind, taking a 6 to 18 month horizon, focusing on valuation, but also looking at macro, political factors, fundamentals. The output of this process right now is that we are underweight the long treasury asset class in our portfolios. So, to your question, we won't need to rebalance because we are positioned for rising rates tactically, given that the real rate is at -1%, close to an all-time low, and that ultimately we're in the middle of a reopening. So
True.
you can argue whether we're early or mid-cycle, but it's not late cycle for sure.
Sure. Sebastian, you're the head of global, the global asset with T. Rowe Price, and with foreign stocks. One of the questions I get asked quite a bit is about the Chinese stocks that are publicly traded, and I'm thinking of Didi, although there are others that are Chinese stocks that the Chinese government is right now clamping down on. When you have asset allocations, does that concern you any, or how do you look at when you're balancing your portfolio? What do you think about the Chinese stocks?
It does worry us, the increase in regulatory risk. But as one of our portfolio managers put it, who's been managing stocks in emerging markets for many years, this has happened before and it tends to happen cyclically. So I think it becomes really important to think about security selection when you allocate to emerging markets or to China in particular. One thing we like at the moment, and where we've added in our portfolios, is an emerging markets value, of which a good portion is in China-based stocks, but with good, deep fundamental research on which stocks we want to own. But there are other risks and other opportunities with respect to China. One of the key issues for Chinese stocks, but also for global markets in general, is that China has been pulling back on stimulus. We've just been talking about this 2 trillion, and we have infrastructure coming in the US. The impulse from China, the rate of change, is going the other way, which is a risk we're watching for global financial markets and for emerging markets and for China in general. But stepping back from that and going back to our 6 to 18 month horizon thinking, that's mostly valuation-based thinking, there is an opportunity to be overweight emerging markets because the currency component is quite cheap. Emerging markets are the asset class of choice historically in a recovery. Trade is set to increase. You do have barriers and trade negotiations that are probably going to come back to the forefront sooner than later. But overall, as global economic activity continues, and you're a little bit behind on the reopening in a lot of emerging markets countries, which means you have room for upside, there's an opportunity to lean in. We tend to be pretty well diversified right now. So take the statements I'm making, like leaning out of stocks, leaning into value, leaning into small caps, leaning into emerging markets, liking emerging markets value. These statements are ways that we tactically position our portfolio to take advantage of shorter term opportunities. But now's not the time to be a hero. Even when you look at value versus growth, you need some growth. You can overweight value, but you need some growth.
I understand.
I would never advocate for concentrated position, get out of stocks completely. If you give me 30 seconds to give anybody investment advice in an elevator between floors 8 and 10, I will say this: stay invested, stay diversified. That's how I would use my 30 seconds.
Well, that leads me to one of my final questions. Is that you wrote a book called Beyond Diversification: What Every Investor Needs to Know About Asset Allocation. What does every investor need to know about asset allocation?
Yeah, I love that.
Think of us that we're in the elevator right now.
That's a great question, because the answer takes 300 pages, but let me give it a shot.
Well, I've got about 60 seconds.
Here we go.
Okay.
3 sections in the book: how to forecast returns and interpret economic and valuation data, how to forecast and better understand investment risk and exposure to loss, and then how to build portfolios. And if you don't want the recipe, but you want the cake at the end, you can go to the 3rd section and look at model portfolios. If you're interested in how the pros do it, if you will, then you'll get a lot out of the book. There's no equations. I've added some wisdom from my father, who was a finance professor. I took 2 of his classes. I have some anecdotes, stories, analogy, a lot of things I've accumulated from my 20 years in the business. I'm not a writer full-time. I'm a practitioner. So this is my book. This is my chance to really come out and try to summarize for hopefully a fairly broad audience that understands finance, though you need to have basic knowledge to follow it, but make it accessible and really summarize this 20 years of industry experience, but with the focus on the latest research, sort of the cutting edge of academics and practice, and also what I've learned from my colleagues at T. Rowe Price. And as I said, so some of the lessons from my father as well.
Last question. Is that, when you talked about the 60-40 rule, is that the 60-40 rule of the percentage of how much in 60% as compared to a 40% allocations?
Yeah, and that is a way to describe beers and burgers type of asset allocation, right? Sort of the basic elevator type advice. It is a specific risk profile. And I do explain in the book, you kind of need to modernize it given how low rates are right now and given what we have in terms of expected returns on capital markets. So I'll walk through a model where I modernize the 60-40 portfolio in different ways.
Great. Sebastian, I've got a lot more questions. I hope you come back because we've only scratched the surface, and that's even of your book. Okay. Thank you so much. Appreciate it.
Thank you.
Thanks, Sebastian. Appreciate it. Well, if you've got a question about finance or a comment about the show, we'd love to hear from you. You can write us at andre@wallstreetwrapup.info. Keep it pithy or concise. We'll be glad to answer your questions. And now for a look ahead for next week. But first, in 1963, Hershey Chocolate Company merged with what candy company? We'll have that answer in just a minute. In 1963, the Hershey Chocolate Company merged with what candy company? The answer, H.B. Reese Candy Company. 6 years later, by 1969, Reese's Peanut Butter Cups became Hershey's top seller. Well, Ochsner Health has over 130 locations around the southeast region of the United States. And with over 26,000 employees in just the state of Louisiana alone, it's also the state's top private employer with revenues of over $5.9 billion last year and growing substantially. Next week, my guest is going to be the president and CEO of Ochsner Health, Warner Thomas. What should we know about the new Delta variant we've been all hearing about? And how will this affect maybe elective scheduled procedures? Next week, the president and CEO of Ochsner Health, Warner Thomas. Coming up in the weeks ahead, in fact, we'll be discussing the airline industry with the former CEO and chairman of the board of United Airlines, Oscar Munoz. Remember, we also replay the show on Sunday mornings, but the best way is to set your DVR so you'll never miss a show. And that is our show for Friday, July 30th, 2021. Hope you've enjoyed it. My thanks to Sebastian Page, and my special thanks is for you for allowing us into your homes this evening. Remember, you can always follow us on Facebook and WYES.org. So have a great weekend and an even better week ahead. I'll see you next week. For Wall Street Wrap-Up, I'm Andre Laborde. And remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.